Greetings from the Bombay Chartered Accountants Society. My name is CA Divya Jokhakar, and with me we have CA Nilesh Kapadia. Today we are going to present Are You Aware series, the first time ever online video series by the International Tax Committee of Bombay Chartered Accountants Society, lovingly and professionally known as BCAS. These series will speak on various topics and practical guidelines and issues related to international taxation, including FEMA angles. Nilesh Bhai is going to answer questions that I will be asking him throughout this session on topic of foreign tax credit in India. Today, we have a lot of questions regarding the practical angles, and Nilesh Kapadia is a tax committee member of Bombay Chartered Accountants Society. He is a partner since 42 years with NMK and Company LLP, and he's also the vice chairman of IFA India. We're very happy to have him on this presentation. As we go along with the questions, in case if there are any questions that you have as a viewer, you can put it in the comment box while the presentation is being viewed by you on the YouTube channel or any other social media. Please spread this video link to all your friends and professionals around so they are aware of the questions regarding to foreign tax credit. Hi Nilesh Bhai, welcome to this session and we are very happy to have you with us.
Good morning, Divya. It is a pleasure always to take part in any event being organized by BCS, and it is a privilege to be part of this first session. And it is a very good initiative taken by the committee. And my full congratulations to you and the team to think of such an initiative. Before we proceed, I will just like to add that in this short question and answer session, which we are going to have right now, it will be a very brief overview of the legal provisions from the practical angle, and one would need to look at the specific provisions in case of any doubt. And as you mentioned, they can always reach out to us by asking questions, because it is not possible to cover all possible scenarios in this short session.
Sure. Thank you, Nilesh Bhai, for the clarification. I'll begin with the first question. What is the meaning of foreign tax credit? Could you elaborate for those who just don't understand what that means?
Divya, you are aware that any resident Indian is taxable on his global income, whether he earns it in India or outside. It may be received, deemed to be received, accrued, deemed to accrue in India, and so on. So once he is taxable on this global income, it is also possible that he is paying some tax in the other country from which he is getting the income. And the foreign tax credit basically means that you are allowed by the Income Tax Act in India to set off the taxes paid in the foreign country, so that as a net result, you pay only the difference of tax, if any, between the tax payable in India and the foreign taxes paid in the foreign jurisdiction. That is the foreign tax, and you will means the Indian taxpayer will therefore pay only the higher of the two, means the Indian tax or the foreign tax. He will not be paying taxes in both the countries. And another important feature in this foreign tax credit is that it is available even in respect of incomes earned or taxes paid in countries where there is with whom there is no double tax avoidance agreements signed by India. So that way India is ensuring that all the global players from India get a level playing field.
Okay, so I think that takes me to the next question, which is relevant to what you just said, that we can take the foreign tax credit with the countries with whom we have signed the treaty. Who can claim the credit of foreign taxes was the question that you've already answered. But how does one know what is required to be done before e-filing the ITR? What are the nuances that one needs to take care of?
Yeah. So basically, one needs to see that the foreign tax credit has been claimed in the correct manner, and there are specific rules provided for this. There is rule number 128, which has to be observed, and there is form number 67, which has to be filed. And couple of clarifications at this stage are necessary so that our discussion in future will be understood by the viewers. One is that, as I mentioned, this credit is available to resident Indians, But there are judicial precedents that even persons who are not ordinary residents will be entitled to this credit. And this credit is available to be set off against not only the taxes paid in India, but also against the surcharge and the cess which we are used to pay in India. And credit is available only for the taxes paid in the foreign country, not for interest or penalties paid in that country for any reason. If there has been a default under that country's local tax laws, you will not be able to claim credit for the interest or penalty paid over there. You will be able to claim credit only for the taxes paid over there.
Okay, I understand that. But is there any way we can rectify or revise this Form 67? And to that, does it have a due date? Do you require e-verification? Or is there any timeline by which you can file the form? Can you postpone the due date just in case you can't file it in time because the TDS credit has the challan from the foreign country or the receipt has not come to you?
See, the foreign tax credit, as I mentioned, one has to file form number 67. Earlier, till 2022, the position was that one has to file form 67 before the due date for filing the income tax return. Now, after 22, by virtue of a notification issued, the form number 67 can be filed up to the end of the assessment year. This is because the government has recognized that it may take time to collect the necessary evidence of taxes paid in the foreign country, and you might have to file the income tax return in that country to determine the exact amount for which you are getting the claiming the credit, and so on. So the time limit is now up to the end of the assessment year.
Okay.
And one more point is that you mentioned about revising the form. Technically, one can revise it, but there are certain practical issues which I would like to highlight at this stage.
Yes, please.
If you file the form 67 based on data available with you and file your return of income, because that due date of return of income will not change whether you have foreign tax credit or not. And in case you want to revise it, but by that time your return has been processed in India, you get the 143(1) intimation, which nowadays comes very fast. Because I recollect last year when I filed my return, when I left my office, by the time I reached home, I got the intimation. So
Oh,
with
wonderful.
this very fast processing, how does one claim the credit belatedly? You may be able to file a return, you may be able to file a form 67 again till the end of the assessment year. But how do you actually file the revised return? These are certain questions which need to be addressed by the government, and one hopes that this is clarified in due course. I am reminded of the Calcutta Tribunal decision in the case of Price Waterhouse, which is a 2020 decision, where the Income Tax Appellate Tribunal directed the revenue to consider the claim, even though the claim was not made in the original return. So does this mean that in all cases the SSS will have to go for litigation? Only time will tell.
Sure. But while you submit this Form 67 and you file the ITR, are there any kind of documents or attachments that go on the e-filing portal? And also remember there is a schedule called Schedule TR in your ITR, which says tax relief has to be informed separately in the return. Just in case I have to claim a foreign tax credit and I don't have a TIN, which is the tax identification number in the foreign country, what is the recourse available?
See, there are 2-3 questions here bundled together. I will take them one by one.
Sure.
The last one I will take first.
Yes, the
TIN
TIN.
number. See, normally when you say that you are claiming for foreign tax credit, if you are filing returns in that country, you will get a tax identification number, which is equivalent to our permanent account number. And we are supposed to mention that in form number 67. But sometimes you are not filing a return in those countries. For example, you have only dividend income, you are holding some shares, maybe because of ESOPs received by you, and you are paying at the time of payment of the dividend, the taxes are withheld at source, and you are not filing any return in that country. There is a clarification issued that if you don't have a TIN number in the other country, in the host country, you can mention your passport number, and that is good enough to claim the credit, which is to be claimed. Coming to the documents to be attached. See, there are 3 types of documents, and one has to attach one of them. One is the evidence of payment of taxes by way of a maybe a TDS certificate or a dividend warrant or a challan evidencing the payment of tax, or it can be a declaration signed by the payer that this much tax has been withheld from the income paid to you. And the third is that the SSC himself can give a declaration that this is the foreign taxes paid by him and support it with the whatever evidence he has in respect of that tax payment. So that way there is quite a bit of flexibility on documents to be attached. But yes, something has to be given as a supporting to claim the foreign tax credit.
So I'll just like to add one question here, just in case I do not have the receipt of the tax deducted in foreign country, and let's suppose I do not want to miss the original filing return. Can I give a letter like an affidavit on my client's letterhead saying that this is the foreign tax credit, this is the income which I've received from foreign, which has been offered in whatsoever schedule in my ITR in India, and I have got no refund or have no disputes against that, and this is my signed management representation letter. Will that suffice, or else does it additionally have to be supported with the receipt that you uploaded?
See, I don't think an affidavit is required. What is required is that you give a declaration. It can be on a plain paper, giving the details of the income and the taxes paid. But if you do not have any counterfoil of a challan or a TDS certificate, then you will have to attach something to support that why you are saying that this tax is paid in the foreign country. You may have a dividend warrant, like we used to get in the good old days when dividend was received by check in your account. You used to get, and today also many companies send emails that this much is the dividend, this much is the tax deducted. And in India, of course, they are required to give the TDS certificate in Form 16A. Some countries may not be providing, or it may not be properly preserved by the taxpayer. So even the dividend warrant is good enough. It can be attached to the declaration. And if there is no TDS certificate, there is no challan, the declaration is good enough.
Okay, fine. The next question is, can there be a situation that you have no tax liability in India, but you still have paid foreign taxes outside? Will India allow such taxes in the ITR? And also, I'd like to club one more question which I had was, what happens in case those incomes are exempt in India, which we can elaborate more towards the end also. What is your viewpoint?
Divya, as I mentioned, the government is quite proactive in terms of giving the foreign tax credit, whether or not you have a double tax avoidance agreement or not. But no country in the world, whether India or any other country, will give you refund of taxes paid in another country. They may allow you to set off while you pay the tax in India, and they say that you pay only the excess tax. But if there is a loss, for example, if there is a loss in India on a global basis, and you are finally not paying any tax, then India is not going to give you refund of taxes paid in the foreign country. Two related questions I will take up right now. One is, if in the subsequent year the Indian income, there is Indian income, and that loss is set off, whether it is possible to claim the credit for the foreign tax in the second year? The answer is no, because the rule very clearly mentions that the credit will be available only in the year in which the income is offered for tax in India, and the income was offered for tax in year one when there was a loss, and therefore you will not be able to claim a credit over here. Related question is whether you can claim the foreign tax paid as an expenditure. One is aware of section 40A, which says that no deduction is allowable for any taxes paid. But taxes in this context, one has to refer to the definition of tax in section 2, which says that tax means tax as per the Indian Income Tax Act. And there are several judicial precedents to say that taxes paid in foreign countries can be claimed as a deduction under section 37 as expenditure incurred for earning income, and it is not covered by section 48. So that is the another incidental claim one can make. If you are not able to claim the set off, at least you can claim the expense and reduce the income in India or increase the loss or set off in future.
Great. Now, when we talk about these foreign tax credits, which period do you need to cover to compute your foreign tax credit in your ITR? Because most of the foreign countries will follow the calendar year. Of course, when you see the ITR, it shows that the period for foreign assets and foreign income needs to be disclosed separately. Foreign assets have to be disclosed for the calendar year till December. However, the income has to be clubbed on financial year basis. So what is your take on it?
Divya, we are having the financial year as the previous year for which the returns have to be filed. So the income earned in the financial year has to be offered for tax, and whatever income has been offered for tax, taxes paid on that income are eligible to be taken as foreign tax credit. So if you have paid foreign taxes for the calendar year, I will give a simple example for the year ended 31st March 24. You might have 9 months of income in the calendar year 23 from April 23 to
Yes.
December 23, and the remaining 3 months are in the first 3 months of the calendar year 24. So you are required to claim the credit for taxes paid in those 9 months plus 3 months, and on that basis, when you offer for tax, you will claim the credit also accordingly. At the same time, I am aware that practically there are certain consultants who are taking the view that you go always on the calendar year basis, so that you will claim the credit for the calendar year 23 in assessment year 24-25 and so on. That is also generally not being questioned by the department, but if one takes a strict legal view, it has to be pro rata for the income which you are offering and for the taxes paid in that period. I will just add that taxes paid in that period means taxes paid on the income earned in that period in the foreign country. For example, for January to March 24, January to March 24, you might pay the taxes sometime in June 24 or
Right.
December 24. But that date of payment is not relevant. What is relevant is the taxes paid in respect of that income in the home country, in the host country.
Okay. So that's fair once you take the proportionate income as well.
Yeah.
Okay, fine. Now let's say that what will happen if we have FTC in India and the foreign tax country subsequently raises a demand, which of course is additional tax, and you are not allowed to contest against that, demand, and there is no way you can manage that. Can you still take that foreign tax credit?
See, as you mentioned a while ago, you will be able to claim credit for the undisputed taxes paid in the host country. If the taxes are disputed, you will not be able to claim the credit. In fact, then one of the averments in Form 67 itself is that there is no dispute against the taxes paid. And if there is a dispute, you will have to defer till the final dispute is resolved, and only finally the amount of net tax actually paid post resolution of taxes will be allowed to be set off in India. If you have filed a return and claimed the credit, but later on the credit which you are entitled to increases because you have been asked to pay more tax in the other country, yes, you can claim that provided it is undisputed in the other country. This is again subject to the rider I mentioned earlier, that how does one actually claim, because if by that time the income tax return has been already processed or the assessment completed and the issue is no more open, maybe one option is to go to the CBDT in terms of section 119 and request for a condonation of delay, saying that this delay was not attributable to any error on the part of the taxpayer, and it is a bona fide case for allowing me to claim the credit and get the refund of taxes paid earlier.
So in that case, can I revise the Form 67 and also parallelly revise my ITR without going to section 119?
See, there is a time limit for filing the revised return. If that time limit has not expired, you can file a revised return. But if the time limit has expired or if the assessment is completed, then there is no option but to go to the section 119.
Sure. Okay, great. How does one know whether to mention the article of the treaty or section of the income tax in Form 67 while claiming the credit? Where do I need to mention it?
See, one of the questions over there is that whether you are claiming in the Form 67, whether you are claiming the credit under section 90 or under section 91. 90 is for cases where there is a double tax avoidance agreement with India, between that country and India. And there you are required to mention the article number of the relevant treaty. As we know normally that there is article number 10, 11, 12, which deal with interest, royalties, fees for technical services, which are very common grounds for which the foreign tax credit is being claimed. So one has to look at the specific treaty and quote the required article at the place. And if you are claiming credit for taxes paid in a country with which India does not have a tax treaty, then you have to select section 91. And there, of course, as there is no treaty, there is no question of mentioning any article.
All right, that's great. But now also I realize there's one more question regards to this before we end the conversation with some trivia questions. The main technical question is, can the FTC as per treaty be reduced by Form 67 Rule 128? So there are two parts to it. If DTAA provides for full tax credit, can Rule 128 restrict to ordinary tax credit? And if treaty provides for the tax sparing, can Rule 128 restrict it to the actual tax paid? So this is becoming a little hyper technical for me. If you could break down the meaning of tax sparing and what are the rules about?
Divya, if I was to talk about the tax sparing, maybe we'll have to take another session to discuss that.
Sure.
But briefly, tax sparing is the credit for taxes spared by the host country because of certain local issues. And there are certain treaties between India and such countries where you are entitled to the credit for the taxes not actually paid but spared in the foreign countries. For example, Mauritius is one such country. But so under the treaty obligation which India has signed under the treaty, you are supposed to give the foreign tax credit in respect of the tax paid in Mauritius.
Right.
But if you look at form number 67, it refers to only taxes paid and you have to give the details of tax payments. So how does one actually say that this taxes spared in Mauritius have been paid in Mauritius because they have in fact not been paid? So this is the case of classic case of the tail wagging the dog, where the form 67 requires you to give dates of payment of taxes which you have actually not paid, and the section 90 and the treaty permits you to claim make a claim of such taxes. So these are the couple of the other examples which you mentioned about the full tax credit and the ordinary tax credit. That also is a case of what is permitted under the treaty is not permitted because of the form, and therefore one will have to take a practical view on how to fill up the form and maybe supplement it with some addendum or a note, because without that, unless it is done at the time of filing of return itself, if you don't claim it, there is no way you can ever claim it. So one will have to look at practical ways to make the claim.
All right, sure. So now let's hit some trivia questions. I really have some quick questions before we end this beautiful conversation, because I kind of was very thrilled to hear the answers. Once, let's say, suppose I earn dividend income of USD $100 and tax is deducted at 25% in USA. Whether I will get the full tax credit, assuming that I am paying 20% slab rate tax in India as an individual.
See, as I mentioned earlier, the credit will be restricted to the tax payable in India or tax paid in the home country. So if you are paying tax in India at the rate of 20% only, then you will not be able to claim the credit of full 25%, but only to the extent of what you have paid in India. And that also one has to calculate the average rate of tax. Means if you are in the 20% slab, maybe if you calculate the average rate, it might come to 15 or 18 or whatever. Then you will get the credit for that number and not 25%.
Not 25. Fine. So to the extent of whatever is my liability in India.
Absolutely.
Right. Let us say I'm a private limited company and I'm a domestic Indian company. I have received dividend from my holding company and I'm a I have a step down subsidiary. So I'm also shelling out dividend to that company. And hence I'm claiming the ATM section deduction, which says that to the extent I have distributed a dividend, whatever dividend is received can be taken as a deduction before filing the return under the due date of 139 subsection 1. Now, in that case, how does the foreign tax credit play? Because the foreign country is giving me the income has already possibly deducted my withholding taxes abroad.
See, this is a very interesting question, because that income is certainly taxable in India, but because of a specific provision of section ATM, you are not actually paying tax on it. You get a deduction, and it is, though it is part of the gross total income, it is not part of the total income on which you pay the tax in India. If we look at the spirit of section 90, the treaty, and form 67, rule 128, etc., I am supposed to get credit for the taxes paid in the foreign jurisdiction. I'm offering that income for tax, and because India has got certain benevolent provisions in respect of dividend, I'm not actually paying tax on that. But whether that amount is taxable in my hands, yes, certainly it is taxable, and therefore, in my view, one is able to claim the credit for that taxes paid, even though you are not actually paying tax. And I can recollect of certain decision where under section 35D there was a deduction available, and therefore the net taxable income was lower. But still, one could claim the deduction. The tribunal has held that you are entitled to claim the on the gross amount and not on the net amount. Claim the FTC on the gross amount.
Okay, fine. So that's quite clear.
And I will just before you end, I will just also highlight that there is another decision of the Mumbai Tribunal in
Yes.
the case of Bombay Burma, that if you are having branches in different countries and you have a profit in one and a loss in the other, so you are not required to set off the profits and loss of all the foreign branches. You can claim the foreign tax credit in respect of the taxes paid in the country where there was a profit, and you need not net it off against the loss in another country. And therefore, to some extent, this also supports the view which I expressed in respect of ATM, that what if whether it is a part of your gross total income or not, that is what is the crucial fact one has to see.
Okay, wonderful. But are there any other points that you would like us to take care of while we are filing Form 67 and ITR? Just general points from your experience in the past before we just end.
I had a very bad experience in respect of Form 67 prior to 2022, where one of my clients was in the ICU and he had to file the Form 67, and the requirement was that it has to be filed before filing of the return of income. And return of income at that time, one used to get 120 days to do the e-verification. But unless the Form 67 e-verification was done, I could not file the IT return. And I had a very difficult time in asking his family to give me the OTP for the e-verification of Form 67. They were saying, why you are harassing at this delicate stage. But luckily now that has changed, and now one is able to, one gets a longer time to do the e-verification of Form 67.
Oh, wonderful. But thank you, Nilesh Bhai, for your time. There's so much clarity that we have got now as viewers. And it was a wonderful session. Thank you to BCS. Thank you to you once again. And good luck to all of us who are filing Form 67 along with the ITR and in showing the income as foreign tax incomes. Thank you very much.
My pleasure, Divya. Anytime for BCS, anytime for you. And it was a pleasure speaking to you.
Thank you.